Here's something wild. Jake Morrison is 22 years old, works a regular job, and has been putting in $100 a month since he was 19. He has never picked a single stock, never watched the market. He just set it up, forgot about it, and right now, 3 years later, his money has grown to over $4,000. I'm going to show you exactly what he did, and I promise it's simpler than you think. Imagine your friend is opening a coffee shop. He needs money but doesn't have enough, so he comes to you. Give me $1,000. I'll give you 10% of everything this place ever makes. You agree. The shop blows up. Suddenly your 10% is worth 10 times what you put in. That's ownership. That's literally what a stock is. Big companies, Apple, Amazon, Google, do the same thing on a massive scale. They split themselves into millions of tiny pieces and sell them to the public. You buy a few, you become a part owner. The stock market is just the place where all that buying and selling happens. Company grows, your piece goes up. It struggles, your piece goes down. No finance degree, no complicated math. That's the whole idea. You can't walk up to a company's office and ask for a share. You need a broker, an app that connects you to the market. In the US, look at Fidelity, Charles Schwab, or Robinhood. Download, create an account, link your bank. That's the setup. Now you search a company you believe in. Hit buy, and your broker sends that order to the exchange, the New York Stock Exchange, or NASDAQ. In literally seconds, someone who wants to sell transfers ownership to you. You're now a part owner. 2 order types. A market order says, buy it right now at whatever the price is. Fast, simple. A limit order says, only buy if it drops to this price. More control, but you wait. As a beginner, market orders are completely fine. The important thing is you actually hit the button. That single action puts you ahead of most people your age. One reason underneath everything: more buyers than sellers, price goes up. More sellers than buyers, price goes down. Supply and demand, same as anything. But what drives that? 3 things. Earnings. Every few months, a company announces its actual profits. If they beat expectations, millions of people rush to buy. Price jumps. If they disappoint, people panic sell. Price drops. Simple cause and effect. News. COVID hit in 2020, an airline. Stocks crashed within days because everyone knew nobody was flying. Elon tweeted about Dogecoin and it spiked overnight. News changes how people feel about a company's future. That feeling moves the price. Herd mentality. People see a stock rising and panic buy so they don't miss out. They see it falling and panic sell so they don't lose more. Everyone following everyone. This is why markets go irrational. The price stops being about reality and starts being about emotion. When you see a stock moving, ask one question: is this real performance or just fear and greed? That question alone will protect you from most bad decisions. Stick with me for the next 5 minutes, because what I'm about to cover is the exact part where most beginners go wrong and lose money. I don't want that to be you. I need to be straight with you because most finance content skips this part. That's exactly why people get hurt. Think about Sarah. She's 24, saved up $5,000 over 2 years, and in January 2020, she put all of it into the market. She felt smart, she felt ready, and then COVID hit. In 6 weeks, her $5,000 dropped to $2,900. She opened the app every morning, watched the number fall, and in March, when it was the absolute worst moment to sell, she sold everything. She locked in a 42% loss and walked away. Here's the painful part. If she had just closed the app and waited, her $5,000 would have recovered completely within 14 months and grown to over $8,000 by 2022. Sarah's mistake wasn't putting money in the market. Her mistake was putting in money she couldn't emotionally afford to leave alone. So before you invest a single dollar, answer these 2 questions honestly. Can I leave this money untouched for at least 3 to 5 years? And if it drops by half tomorrow and stays there for months, Will I be able to not touch it? If yes to both, you're ready. If no, build your emergency savings first. Investing is powerful, but only if you let it work. Step 1. Do not start with individual stocks. Even professional fund managers with entire research teams get it wrong more than half the time. Your smartest first move is an index fund. An index fund buys a tiny piece of every major company at once. So instead of betting on one company, you're betting on the whole economy. Historically, the whole economy always goes up over long enough time. Less stress, solid returns. Step 2. Dollar cost averaging. Pick a fixed amount, $50, $100, whatever, and invest it every single month, no matter what the market is doing. Market up? Invest? Market crashing? Still invest. This automatically removes emotion from the equation. You buy more shares when prices are low, fewer when prices are high. Over years, this evens out to a strong average. It is boring. It is also how Jake from the beginning of this video grew $4,000 from $100 a month. Step 3. Start now with whatever you have. $25 a month builds the habit, and the habit is the whole point right now. The amount grows later. The habit has to start today. Myth 1. You need a lot of money. False. Most platforms let you start with $1. The barrier is your belief, not your bank balance. Myth 2. It's basically gambling. Gambling means the odds are always against you and the house always wins. An index fund is backed by real companies, real products, real revenue, completely different. Myth 3. You have to watch it every day. The people who check daily make the worst decisions. They panic sell dips, greed, buy spikes. The best investors are the ones who forget they have an account for years. Boring wins every time. Myth 4. The market is rigged for rich people. 20 years ago, maybe. Today, a 19-year-old in Ohio has access to the same funds as a Wall Street banker. Index funds and zero-commission platforms changed everything. Myth 5. I'll start when the time is right. Every month you wait is compound growth you're giving away for free. The right time doesn't exist. Today does. One quick thing. Drop a comment right now answering this. What was the one thing stopping you from investing before this video? Fear? No money? Just didn't know where to start? Tell me below. Your answer might literally become my next video. 2 options, that's it. For beginners, start with Fidelity or Charles Schwab. 0 fees, no account minimums, and you can set up automatic monthly investments in under 10 minutes. Both are regulated by the SEC and FINRA, the most trusted financial regulators in the country. If you want something even simpler on your phone, Robinhood works too, though Fidelity is the stronger long-term home. Before trusting any app, check the fees, confirm it's SEC and FINRA regulated, and if you feel confused opening it, that's a red flag. Close it. One app. Open it today. Jake put in $100 a month for 3 years, didn't touch it, didn't watch it, didn't try to time the market, and he has over $4,000 today. That's the whole secret. An index fund. Monthly fixed amount. Don't panic. Time does the rest. Next week, I'm breaking down how to actually pick your first stock, not the boring textbook version, the real way. What to look for, what to avoid, how not to get played by hype. Subscribe so you don't miss it. That's it. Go open the app.